1A. This is an offer from, this is where you put in the name of all of the buyers that are in the transaction. You don't need to put their vesting, but if you have 4 buyers, you need to have 4 names here. And you should put their names in this space the way that they want them to read throughout the escrow. So if they use a middle name or they have a certain way legally that they use their name, that's the way it should be written in here. It's always important for you to check with your clients and find out how their names are on their identification, because these buyers, if they're getting a loan, they're going to have to sign loan documents at some point, and in order for a notary to notarize those documents, they need to have identification that reads the same as the loan doc. So that is the important thing about how you're going to put their names in paragraph 1A. 1B, simple enough, just says the property to be acquired. You put in the property address, the parcel number, and I'm going to move my little box over here. Put in the parcel number, the city, county. If you don't know where to get the parcel number, you can find that usually in the MLS, or Realist Tax is another place that you can find the APN if you don't know what it is. There's really, it's very simple to get that information, so I think there's no reason to actually leave it out. Purchase price, actually if you skip on this area where you put in the purchase price under 1C, if you just put in the numeric value, it will automatically type it out here where it says $900,000. On paragraph D, close of escrow. Now this is an option, and I've seen people, you know, sometimes they'll say shall occur on, and they'll put a date, you know, November 9th, or, and then they'll say 60 days. It needs to be one or the other, because this is a contract. You need a set time period in this area. Most of the time, you're going to check the box and you're going to put in a number of days after acceptance. The reason that you want to do it that way is that a lot of times when you're negotiating an offer, what will happen is, you know, it may take a week back and forth between counteroffers and all these things for you to get your offer negotiated. And during that time, you can lose a lot of days. So if you put in a specific date here, so say today is September 9th and I put in October 9th, if a week goes by, it only gives me 3 weeks to actually finish out my transaction, which generally is not enough time. So I like the days after option, and it seems to be, you know, what works most of the time. I think you would only use close of escrow on a specific date in the instance where you had to close on a certain day for a certain reason. Maybe, you know, back in the time when we had some issues with the tax credits, that was the time when someone may have been trying to close on a certain date or something like that. So that's the only time you're going to use an option like that. Okay, coming down here. 2A just talks about agency. This used to be at the back of the contract. It used to be toward the end. I think it used to be paragraph 27. Now they've moved it right up front, and I think that's actually where it belongs. The reason I think it belongs there is because we are supposed to give agency to our clients before we have them sign a contract. So what you're supposed to do is introduce the agency disclosure to the client and have them sign it. The agency disclosure simply tells them the 3 different types of agency relationships that they can have with you as an agent. You could be a buyer's agent, you could be a seller's agent, or you could be a representative of both the buyer and the seller. So the agency disclosure, you don't need to circle. Sometimes I see people will circle on the agency, you know, buyer's agent or seller's agent. You don't really need to do that. It's simply a disclosure telling people what type of agency relationship. Where the relationship is confirmed is in 2C under confirmation, and that's this area here. Another thing that I see happen all of the time is agents, you know, you're writing an offer for your buyers, so under selling agent you write Evergreen Realty and Associates Inc., or if you're Evergreen Realty and Loans, you write that in there and you say, click, you know, represents the buyer exclusively. But what people leave out all the time is the listing agent, and I'm not sure why that happens, because of course we know who the listing agent is if we know who to send the offer to. So make sure that you fill out the confirmation portion all the way. The reason it's very important is that when the client signs the agency disclosure, one of the things that it says in there is that per the civil code, they have received somewhere confirmation of who represents who as agents, and this is where they get that. So it's very important that that information is filled out. If you're the listing agent and you receive an offer and that information is not completed, you need to correct it in a counteroffer. So you need to always make sure that that information is filled in correctly. Okay, I'm going to skip down here. So the next section 3 talks about finance terms. You know, buyer represents that funds are good when deposited with escrow. That's a given. There's no, my client needs to transfer money. They need to, you know, wait a couple days before we deposit the check. Your client needs to understand that when they deposit a check, it is expected at that time that the funds are already good. 3A, under initial deposit, deposit shall be in the amount of, I generally use 1 to 1.5% as my guideline when I represent a buyer. I know when we represent sellers, sometimes we want more. We're thinking maybe more like 3%. But when you represent a buyer, I think you want to manage their risk. That's why I think 1 to 1.5% is reasonable. It manages the risk to your client, and at the same time, it's not ridiculous. You don't want to be ridiculous what you put out there. You've got to, you know, ensure the seller that your client has something on the line in the transaction, but you know, you want to make sure that you also manage that. So I like 1 to 1.5%. I think it's a very reasonable amount. One of my favorite things about the new contract that came out is that it says buyer shall deliver deposit direct to escrow holder. We used to request that you guys write in buyer to hold deposit and all these things, buyer to hold deposit until acceptance and deliver to escrow. You don't have to write that in anymore because now by default the contract already says they will deliver it directly to escrow. I personally like to believe that Evergreen started that trend. I'm going to go ahead and take credit for it because we've been doing that for years, and I'm so happy that they've now included it. So right now, you actually can leave the rest of this stuff blank. Because the buyer is going to deliver the check directly to escrow, you don't actually have to say whether it's personal check, electronic funds. It's up to the client how they want to deliver that money. So you just leave it like this and put in the deposit amount. Increased deposit, this area is where you would put in an increased deposit. Now sometimes people put the down payment here, and you don't need to put the down payment here. It's not the right area. Increased deposit is something that you use more often when you have a situation where maybe there's competing offers. You might be in a multiple offer situation, and maybe you say, you know, I'd like my client's offer to look stronger. So what I'll do is I'll go ahead and increase their deposit maybe $10,000, and you could say, check mark the box that says or, and you could say upon removal of contingencies. So basically you're saying once my client has removed their contingencies, my buyer, they're willing to actually even up their deposit more and therefore make their offer even stronger than maybe what else you're up against. That's one of the only times that I think you would really use increased deposit. Otherwise, you don't use it very often. Skipping down into the loan section, C1, this is where you put the information on the first loan. These days, we're not seeing too many firsts and seconds anymore. I'm sure you've all noticed that. Most of the time, it's just one loan. So first loan in the amount of, and you'll put the amount in there. If it's going to be FHA or VA, you can check mark the boxes that are here. If there's seller financing, you check mark the box. One thing I want to point out to you, whenever you see something in parentheses, like right here where it says CAR form SFA, that is an indicator to you that if you're check marking this box, that there's an additional addendum that you should be using. Okay? So that's what that's for when you see it. So you'll be talking about the first loan. It automatically says conventional, so if they're just doing conventional financing, you don't need to check anything. And then you come down to the section where you put in the loan terms. I have here 6%. I might even be high because the interest rates today are much lower. They're really, really good. So maybe you're going to put 5.5 or something else. But you should always put loan terms in. At the minimum, what I have here, 6% fixed rate I have, maximum 1 point. If your client doesn't want to pay points, put 0. The reason this is important is although your client has a loan contingency, that basically says my client will make a good faith effort to try to get a loan. What I like about putting in loan terms is not only does it say they're going to try to get a loan, but it says they have to be able to get a loan that fits these requirements. So if your client, if your buyer can't get a loan that would give them a maximum of 6% interest rate, it's an out for them. And I think that is important, because maybe your client could get a loan, but they could get it at 10% interest. That's not good. It's not good for them. So this is just extra protection for the buyer because the intention of the contract is that they're going to make a good faith effort to do these things. They're going to make a good faith effort to get a loan. So, it would be expected if you put the rate and term in there that you're saying this is the maximum that they're willing to do, and if they can't get a loan that fits in these parameters, we're not going to do it. If there was a second loan, you check the box and put the second loan amount here. You do the same thing. It has all of the loan terms. Something new in the contract is the box here, number 3, that says FHA/VA. In the past, when your client was working with an FHA or a VA loan, in the very beginning, we would say seller to pay, blank amount towards FHA or VA non-allowable costs. And that's always been a really difficult issue because as the buyer's agent, most of the time at the time you're writing the offer, we don't even know what those costs are going to be. So in the past, we would just take wild guesses and put, $2,000 or some number in there, but you never really knew if it was going to cover everything. The new way that the offer is laid out, it says, FHA or VA, for any FHA or VA loan, buyer has 17 days after acceptance to deliver to seller written notice, and there's the form, CAR Form FVA, of any lender required repairs or costs that buyer requests seller to pay for. What this means is that within 17 days of acceptance, the buyer will fill out this form, this FVA form, and when they fill out that form, it looks just like a request for repair, and they're going to, actually I can even call that form up, they're going to fill it out and let the seller know, let me just pull it up here. See, it looks a lot like a request for repair, and it spells out this is what we're requesting the seller to fix and repairs that are required by the lender. And this is the amount of any costs that we need them to pay for. And basically, it becomes a negotiation just like a request for repairs. So instead of everyone having to accept these things blindly, it's a negotiation within 17 days. And if the seller doesn't want to pay the FHA fees or if they don't want to pay for the lender required repairs, then basically it's a contingency and the deal doesn't happen. It really offers a lot more protection. The way the contract used to be set up in the past, it was sort of a trap for the seller because sometimes agents would forget to counter out or put a maximum on the lender required repairs, and when that would happen, sometimes sellers would get stuck paying some really costly repair fees for the lenders. So the way it's done now is much better, and what you need to know is whenever you have an FHA or VA transaction, I'm getting ahead of myself here, use that addendum. Let me get back to where I'm at here. Below that, additional financing terms. This is a great place that you can put in seller to pay $10,000 towards buyer's closing costs if you want to. A lot of people look for it in this area, so that's somewhere that you can put it. There's also other areas of the contract, and I'll show you that, but this is one place that it could go, or if there's any other just blank terms that you want to put in that are not covered in the contract, you could put them there. Balance of purchase price or down payment. They added the word down payment here. This is the remainder of the down payment minus the initial deposit, and of course F gives you the total purchase price. The other great thing that was done is they've separated the initials. They used to have everything lumped together in this section here. Now it's separated. Buyer's initials are on one side and seller's initials are on the other. I think it just makes it easier for everyone to figure out where to sign. Before I go on to the second page, I'm going to click down and see if I have any questions. and we have anything that we want to look at.